In this video, I'm going to show you how I help my clients create a corporate war chest inside their group structure tax efficiently by using some secrets I'm going to share with you today. And that is by assuming you're starting with a trading company, which is going to be your standalone limited company that generates income, expends expenditure, has taxable profits, pays dividends to shareholders, pays corporation tax to HMRC, then has a surplus. And it's worth noting that if you're watching this and you're looking to invest and build long-term wealth, then these are the strategies you need to apply. So in this trading company, you're going to have surplus money that you probably want to invest and get a better return on capital than just sat in a current account earning 1%. The amount of directors that I speak to that have got a NatWest current account, Barclays current account, Starling account, earning subpar interest to what they could be, essentially having their capital rotting away to inflation, is ridiculous. So what you want to do is with this trading company, rather than you owning it directly, let's assume, and you'll have to excuse my artistic drawing here, let's assume that this is you and you currently own 100% of the business directly as an individual. What we want to do is remove your ownership from this trading company, and we want to incorporate a term you've probably heard before, which is a holding company. And that holding company is now going to own 100% of the trading company. And you as an individual are going to own the trading company, thereby forming a group. And the benefits of a group are that the trading company can pass money up to the holdco, separating capital from the trading business, which minimizes risk. Let's say you had a creditor, that something went wrong in the main trading business. You've now separated capital out. That creditor can no longer pursue you for that capital. So asset protection, big tick in the box there. It's now time to review your options and determine where is the best place that you can allocate that capital. Is it investments? Is it a JV with a partner with a new business opportunity? Is it investment into some form of property, so some hard real estate asset? Do you want to go into more volatile assets such as cryptocurrency? And the answer really is a diversified look on all of these different asset classes to allocate your capital in the best way to get the best returns over a long time horizon while considering your risk profile. Now, although I'm not a financial advisor, I know what works for entrepreneurs, and I've seen firsthand what they invest in and how that generates a return back for them with their capital. Let's take you through actually how to do this, how to allocate, the steps that we take with clients, and then build out this structure to be more advanced to help you. So when you separate capital in the holding company, let's use an example that 100K has now been deposited into your holding company bank account. And this is, just for context, a standard limited company that you set up on Companies House, where you do a share for share exchange, whereby it now owns the trading company and you own the holdco. You've got 100K in that bank account. You've already paid all your taxes, your liabilities. You've already reinvested back into the trading company as much as you can to support growth over the long term, because that's always the first place you should start. Now we want to look to invest. So I'm going to run through a few different options with you. These lines represent shareholding, and these are what are called subsidiaries, which is essentially a company that the holding company owns and is now part of the group. So we're going to start here, and this is going to be what's called an SPV. I'm sure a lot of you have heard the term, and what it essentially is special purpose vehicle. And as it states in the name, it's got a special purpose. That special purpose may be that you're going buying a abandoned bank and you're turning it into HMOs, and you're going doing that with a partner of yours that you're currently in the trading company with, or someone that you've met at a networking event. And that 100K is going to be deposited into this SPV via a loan. You're going to loan it from the holdco to the SPV. Now, because the holdco does nothing but just holds the shares, doesn't owe money to anyone, it doesn't have any creditors that are pursuing it, there's no liability or there's no risk like there would be in a trading company. If you was to just loan from the trading company to the SPV, what happens if the trading company goes bum? Well, guess what? They're going to come for your HMOs as well. So it separates risk, and this loan isn't likely to cause any issues for risk management. When this 100K in capital is deposited into the SPV, you now spend. You spend on whatever project you feel is going to get you the best return. And over time, that generates further funds, further net worth. You may then reinvest them funds back into new ventures. And over time, that war chest builds as part of the corporate entity. And guess what? You haven't paid tax to withdraw out 39.35% in dividends to then put into your ISA or to then put in a personal stocks and shares account. You've kept it all inside the corporate wrapper. You've used your contacts that you've generated for your trading company, and you've got a better return on your capital. And it gives you that flexibility to go and JV, bring in partners, allocate shareholdings, and it's protected inside the corporate wrapper. So it's a big tick. This is just one option that you've got. Let's run another option. Let's say you've got another grand idea. You've seen some opportunity with AI, the way that the digital age is currently pursuing, and you've decided to push another 100K in capital from your trading company up to your holdco. This time you go and invest in a new venture. You may not be doing this with a partner, you're just doing this yourself. That 100K is going to go into development costs. You're setting up the business, making sure that it's got all the growth capital it needs to go meet its objectives and targets. That generates a loss, and that loss, providing you're in a 75% group, which essentially means that the parent company owns at least 75% of the subsidiary, guess what? You can claim what's called group loss relief. And that essentially means that the loss you generate in one trading company, you can offset against the profits in another. So you're now using capital to invest, again, separating that risk of having an intercompany loan by passing it up to the holding company tax-free first, then loaning it down to the trading company, investing in an asset, generating enterprise value in a future revenue stream, and now using group loss relief to pass that loss back to offset and get that corporation tax deduction. Again, another big tick and a benefit of a group. Now I want to use one more example, and there's two potential options with this, and some advisors have different opinions. Let's say you want to not do a SPV in property, you've put some money into a trading company, or that's not of interest to you. You just want to invest in more of a stable investment. Let's say you set up what's called a corporate investment account, which you can do with a wealth manager or a financial advisor. You want to invest some money into the stock market, S&P 500, index fund, ETF, a direct stock in a company that you like the look of, really up to you. You could even, if you really want to, go and invest in cryptocurrency. You could get a company exchange account. And let's say you want to do financial investments because you want to get that steady return over time. You don't want the headache of having property contracts to sign. You don't want the headache of setting up a new business because it's going to distract you from your main trading company. You can either then do that via the holdco, but I prefer to separate where possible and set up what's called an investment co, and that is purely for the purpose of investments. You would also refer to this as a special purpose vehicle because it's especially for the purpose of investing capital. Now, one caveat here is there's what's called associated company rulings, which essentially means that once you have numerous different companies, you lose the small profits threshold to pay a lower rate of corporation tax. So if you're not already above 250,000 in total profits, you will pay a higher corporation tax rate if you start setting up a group and numerous companies. But I'm assuming if you're investing 100K upwards into these different investments, you're probably already making above 250K. And if that's the case, then you don't have to worry about associated companies rulings. You just have to consider the additional complexity and potential additional accountancy fees. So at this point, you've had a trading company that's now developed into a holding company that's owned by you. You've now had a JV that you've gone invested in property. You've now had a trading company that you've set up, diversifying and jumping on a trend that's going to produce enterprise value in the long term, potentially a business exit down the road. And you've also started investing in stocks, shares, ETFs, cryptocurrencies, and more. What are you now doing? You're now building net worth, not within one structure, within a group of companies that all interact, build net worth, protect your assets, and it does it tax efficiently. This is what I use with my clients to really build net worth and not pay it all over to HMRC. And there's one thing that I'm going to add as the final nugget here, and that is what's called substantial shareholders exemption, which allows you, providing again you're in a 75% group, to sell a subsidiary company and pay 0% in capital gains or corporation tax because the funds, so the proceeds of the trading company, go up to the holding company, not to you personally. So let's say this trading company here that you've invested in AI has all of a sudden got a £1 million valuation. You sell that trading company to a strategic acquirer overseas. That 1 million goes up to the holdco, ready to invest back into your investments, to your trading company or your SPVs, and it's tax-free. If you've got any questions on how we execute and implement this with clients, let me know in the comments below and let me know what you want me to cover next.